Bond investor Bill Gross was right in his new normal prediction about 5 years ago. Now he's out with a new idea that he calls the new neutral. I'm Jack Otter, editor of BARRON'S.com. I'm here with Mike Aneiro, writes our income investing blog. And Mike, you spoke to Bill Gross on Friday. What's his vision for the future?
This new neutral idea is basically a reference to how he sees the policy rates of central banks around the world converging at this very low level. He sees sort of a sluggish economic growth outlook for the next 5 years. They don't think the Federal Reserve or other central banks are going to be able to raise their policy rates, the sort of what's known as the neutral policy rate, as high or as quickly as people think that they're going to, and that therefore you're going to be sort of stuck in a rut in terms of low rates. It's going to impact bond yields and keeping them low, and it's also going to impact other areas as well.
Now, bond investors, especially Gross, are typically kind of a gloomy bunch, but he did nail it last time. He pointed out that the huge leverage that investors, the homeowners, countries, nations had taken, leading up to the crash would cause the hangover to last much longer than anyone predicted. The problem with that thesis, though, was his investing thesis was actually incorrect. He said, stocks are going to give you lousy returns, and of course we have a wonderful bull market. What is he recommending that we invest in now?
He paints a pretty gloomy picture across investments, actually. For bonds, he says you're going to be looking at about a 3% annual return on average over the next half decade. Stocks, he doesn't think are going to do much better. He sees about a 5% perhaps return for equities, and the general thesis is that in part a lot of the returns have been squeezed out of things like high yield bonds, things like equities over the last several years, as all the low rates of the Federal Reserve have enabled investors to borrow at low rates and invest in higher yielding things, and they've squeezed a lot of that return out. His outlook is a very cautious one, and it doesn't really see any bull markets in any particular asset class. And in fact, he advocates for a little bit of leverage in order to juice returns a little bit.
Borrowing. So how would I do that as an investor? What would I buy?
He makes the case for there being several different types of leverage to look at. There's leverage in the form of, say, closed-end funds. There's leverage. He points out that equities are in fact a leveraged bet because corporate balance sheets are in effect leveraged.
So if I want to buy a closed-end fund to fit the Gross thesis, what would I buy?
He talks about in particular a couple of funds, a closed-end fund and an exchange-traded fund. One is a BlackRock Build America Bond Fund, which is based on the Build America Bond Muni program, which was rolled out a few years ago, and it receives a federal subsidy on the interest. And another one that he recommends is a Pimco, surprise, fund. That's a short duration high yield bond fund, and that allows you to boost your yield a little bit while keeping your risk shorter because most of the bonds are only about 3 years.
So let's say he's wrong this time in terms of what to buy. How big is the downside on these funds?
The downside is not as great as you would be really afraid to invest in right now. The thing that he could be wrong about is the upside potential if he misses out on, say, another equities rally or something like that, because he really thinks that there's not going to be a bull market in pretty much anything over the next 5 years.
That said, it's tough to argue that you shouldn't have at least part of your portfolio in bonds as a shock absorber, so maybe that's the right place to park it.
Yeah, I mean, it's a cautious outlook, and the downside, again, is if you miss out on a bull rally, but it doesn't seem like there's as huge a downside as you might be afraid of.
And that's why we got stocks. Thanks, Mike.